In this video, I discuss why retiring with a mortgage might actually be a smart move. Coming up next on Holy Schmidt.
Holy Schmidt!
Just about every financial plan tells you to retire debt-free, and for good reason. For every dollar you spend on debt, that's a dollar you can't spend on something else. But almost universally, there's a lack of acknowledgement of two things. The first is that if you pay off your mortgage, especially if you pay it off early, you're giving up something else. And that something else is often putting money into investments for your future security. Often the assumption out there is that by not paying off your mortgage early, that you, as the boomer or the Gen Xer, are buying baubles and leisure with your money. And that's usually not the case, frankly. The other, and this isn't really acknowledged at all, frankly, but it should be, is that the benchmark, which is the parents of the boomers, had a different economic situation than the current people that are financing their homes. So let's talk about this. According to the Federal Reserve Board Survey of Consumer Finances, 38% of homeowners between the ages of 65 and 74 still have a mortgage. This is up from 29% back in 2000, basically more or less when our parents retired. More interesting is what happened to the 75 plus homeowners. In the year 2000, 12% of those 75 plus that had a home had a mortgage on that home. In the most current survey, it was 28%, so that more than doubled in 24 years. Did people decide that suddenly that leverage is good and they want to hold as much debt as possible? Well, some did, but the majority didn't. They faced a different set of circumstances. For example, in 1964, basically the age when our parents started having children, more or less, meaning that's about the birth year of a lot of people watching this video, give or take 5 years, the average male was 23 years old when he got married. The average female was 20 years old when she got married. 30 years later, 1994, the age when a lot of people watching this video started their professional life or their work life, the ages moved to 27 for males and 25 for females, which means the need for a house was pushed out 4 or 5 years in many cases. And in 1964, 16% of couples had a baby within the first 12 months of being married. In 1994, it was 12%. All of this points to the fact that our parents bought a house on average 5 years earlier than this generation, more or less. The next point here is what happened to home price inflation versus wage inflation during that same period of time. In 1964, the average home price was $18,400. In 1994, the average home price was $130,000. So it went up 7 times during that period of time. In 1964, the average income was $4,576. In 1994, the average income was $23,754. So income went up 5.2 times over the same period of time. And the 30-year mortgage in 1964, 6.09%. The 30-year mortgage in 1994, 8.38%. Home prices went up 34% faster than income over that 30-year period, and interest rates were higher in 1994 than they were in 1964. Add to that the fact that people who took out a mortgage took it out 4 or 5 years later than their parents. That means that the end point on a 30-year mortgage also ends later. But what happened next was the game changer. Because of a series of economic issues, starting with the global financial crisis in 2008-2009, interest rates went down to about 3%. So all those 8% mortgages were refinanced at 2.5% to 3.5%. And that became a really big, important asset. And by the way, in 2022, about the time the Ukraine war started, interest rates skyrocketed, and today they're at about 6.8%. And if you have excess cash today, you can put it into a short-term government bond fund earning about 4.5%, with a mortgage of 2.5% to 3.5%. All of that's a long-winded way of saying that the reasons today for paying off your mortgage early are different, at least some of them are, compared to our parents' generation. Does that mean that I'm suggesting that you should definitely carry a mortgage into retirement? No, I'm not saying that at all. The fact is, if 38% of the people retiring with homes have a mortgage, that means that 62% of the people with homes retiring do not. People who pay off their mortgages before they retire have good reasons for doing it. The first is the mental freedom that comes with having no mortgage on your house. The psychological benefits are basically security and emotional satisfaction. And in retirement, people deserve the right to feel as good as they possibly can. Next, having low, consistent, predictable expenses wins even if people can invest the excess funds, and get a higher return. And finally, there's risk management. Risk is a real issue for retirees, particularly if they're investing funds that need to be invested for the long term to get the return that they're looking for, but they have short-term monthly obligations in the form of a mortgage. With all of that, why would anybody want to keep a mortgage in retirement? The first is preserving liquidity. Having access to cash or assets that can quickly be converted to cash is important in a lot of life's emergencies. When a retiree uses a large portion of their savings to pay off their mortgage, they reduce their liquidity. The money is now tied up in home equity. Now, this means that in order to get the money out of the house, you either need to refinance your mortgage or take out a home equity loan. And those both come with costs. In retirement, liquidity matters even more so than during your working years, because during your working years, you have income coming in. But if your assets are tied up in illiquid investments, or the availability of a part-time job just isn't there, well, liquidity is very, very important. Unexpected emergencies like medical bills, family emergencies, a house repair, a new roof, a new heating system, a new air conditioning system, all can creep up. And if you don't have access to cash, well, then you're going to be in a very bad situation. You have to figure out how to pay for these big costs. Next is the possibility to invest at a higher return. Keeping a mortgage in retirement, particularly a 3% mortgage more or less, means that, as I alluded to earlier, you can take your excess cash and put that into higher yielding investments. The basic principle here is what's called opportunity cost. If someone has a 3% mortgage, but they can invest at 4% or 5% safely, then their opportunity cost is 1% to 2%. Over the long run, a diversified portfolio of stocks has delivered well in excess of 3%. But even if someone were to take a conservative position on their investments, like a balanced index fund or dividend-paying stock, a highly rated dividend-paying stock, 5% or more is quite likely. For example, let's say that there's a retiree with $150,000 left on their mortgage at 3%. And they look at their investments out there, and there's a conservative investment that pays 6%. After taxes and inflation, the return might be 4%, but that's still 1% above the cost of the mortgage. And over a 10-year period, that is a substantial amount of money. Of course, investing always carries some risk, but retirees who have a conservative portfolio and understand the risks might come out ahead by keeping their mortgage in place. Next is itemizing your taxes. If a retiree itemizes their taxes, their tax deduction, the mortgage payment might be a nice addition to their itemized return, which brings the actual cost of the mortgage down. The value of the deduction depends on your tax bracket, of course. If you're in the 22% tax bracket and you pay $6,000 a year in mortgage interest, you have a tax reduction of about $1,300. Taxes don't reduce the cost of a mortgage, but they do often reduce the net cost, making the low interest rate even lower. And while having a tax deduction shouldn't be the sole reason that you keep a mortgage, it can enhance the benefit of having a mortgage in retirement, particularly if you itemize. Next is a protection against inflation. This means that the real inflation-adjusted cost of your mortgage actually goes down over time. In contrast, other expenses like groceries, utilities, healthcare, etc., generally go up with inflation. They go up over time. But what this really means is that your mortgage becomes a smaller and smaller portion of your overall retirement budget, particularly if you have a mortgage out for 10 or 15 years. Meanwhile, the dollars that you're drawing to pay your mortgage often come from inflation-protected sources like Social Security, rental property. Some investments have a positive return when there's more inflation. Next, diversification of your assets. By paying off your mortgage, you are increasing your concentration in the real estate asset class. I'm not saying that's a bad thing, but know that when you have a home, the value of your home is real estate value. And while a home is a valuable and appreciating asset, it's also illiquid and undiversified. If most of your net worth is tied up in your home, then the value of your net worth is tied to local home prices. But if you diversify and you use the cash for other investments, well, you have a hedge against a falling real estate market. Now, a point that needs to be made here, all of this assumes that you locked in a very, very attractive interest rate, one that probably won't come around again, say 3%. If you refinance your home and you're talking about a 5% or a 6% mortgage, or maybe even a 4 point something percent mortgage, a lot of this doesn't really work. And for many of you, your personal situation may warrant not having a mortgage in retirement, even if you have a very attractive interest rate. If this is possibly you, you should talk to a personal financial planner and have them do an assessment for you. If you like this video, check out that video. Is a fully paid off home in retirement really worth it? This is Jeff Schmidt, and I will see you in that video right there.